Hi, my name is Justin Archote. Thank you for watching my industry analysis as part of Finance 551. Alright, so the objective of this project, we were to analyze 2 industries over 5 years using Bloomberg. Each industry had to consist of 5 firms. We identified firms based on performance. We were to identify the best firm in the first industry, best firm in the second industry, and then kind of put them head to head and choose one overall. So the 2 industries I chose, they were a bit more broad. I didn't want to get too specific. The mass merchant industry, that's going to consist of Target, Walmart, Costco, Dollar General, and Dollar Tree, as well as their tickers on the side. Then e-commerce, discretionary industry, that's going to be Wayfair, Netflix, Amazon, Apple, and eBay. So first we'll start with the mass merchant industry. A little bit of description, won't read all this. I'm sure you're familiar with Target. General merchandise discount stores focus on merchandising operations, which include general merchandise, food discount stores, and they're online as well. Then we have Walmart. I know you've heard of Walmart. Discount stores, super centers, neighborhood markets. They offer just about everything under the sun. Costco. So Costco operates wholesale membership warehouses in multiple countries. They sell all kinds of food, automotive supplies, toys, the list goes on and on. Dollar General, they have a chain of discount retail stores located primarily in the southern, southwestern, midwestern, and eastern United States. You can't seem to drive 2-3 miles around here without running into a Dollar General. And then a competitor of Dollar General, Dollar Tree, they operate a discount variety store chain in the U.S. They sell an assortment of everyday general merchandise. If you've ever walked into one, you'll see they have a little bit of everything. All right, so we're going to start off with short-term solvency. Taking a look at these current ratios, nobody was too far below 1, meaning that nobody had a great deal of current liabilities that outweighed their current assets. So this really didn't worry me too much. This is not going to be a huge deciding factor for me. I was comfortable with each company. And this kind of gives you a more complete picture looking at current ratio, quick, and cash. Once again, like I said, current ratio, everybody was around the same ballpark. Nobody really stuck out to me or worried me. So then we look at quick ratio, so we take out inventory. Obviously, these firms are going to have a ton of inventory. That's what they're selling. So whenever we move from current to quick, we do see a huge drop in numbers, just like we would expect. In terms of quick ratio, I like Costco and Dollar Tree. This shows me that they have, assets other than inventory, more so than the other 3 firms that are not highlighted in green. Then we take cash ratio. Nobody has a whole lot of cash on them in this industry. But if I had to pick, I like Costco and Dollar Tree. So now looking at long-term solvency. Looking at equity multiplier, I like Dollar General. So they had the lowest numbers here. Obviously, less debt is better. So we're looking, they ended up with 2.1, and they were pretty consistent over the 5-year period. If you notice, Costco is in 2013. I think it just had something to do with the way the fiscal years worked out. But I did take the 5 years. Theirs just ended in 2017, and the other 4 went on through 2018. Obviously, they can all afford their interest. Bloomberg evidently could not pull Dollar Tree's times interest earned ratio. All right, so if we, as part of my return on equity decomposition, we're looking at tax burden, interest burden, and EBIT margin. While the higher the number here, obviously paying less in taxes, paying less in interest, we like that, but we don't necessarily want these to be driving the numbers with return on equity. So I put them up here, but it's not something we want to focus on too much. In terms of interest burden, I like Costco, I like Dollar General. Now, EBIT margin down here, that's a whole other story. EBIT margin, operating margin, this tells us how efficient are we? How efficient are our managers? Are we limiting expenses? Operating expenses. So the 2 favorites here were Dollar General and Dollar Tree. We see a lot of consistency here, and we like that. Profit margin. So Dollar General, once again, we see their profit margin and it's increasing. So over the 5 years, we'd like to see an increase, even if it's small. We like to see consistent numbers. We don't want to see numbers all over the place. But Dollar General and Dollar Tree, we see, Dollar Tree drops a little bit here, but they come right back up and they end up higher than when they started. So I like Dollar General, I like Dollar Tree here. Total asset turnover, how efficient are we at turning over assets? Walmart seems to be the king of this. And I was actually surprised Costco was a little bit higher. So Walmart and Costco were kind of the leaders with total asset turnover. We already looked at equity multiplier. I just want to put it on here to give you a more complete picture. Return on assets. So once again, Dollar General. They were significantly higher than the other four. They were consistent and they were also increasing over the 5 years. Ended up at 12.72. Return on equity. So I like Target here, I like Costco here, and I like Dollar General here. We see increases, a little bit of dip here on Target with a negative number, but that was just 1 year. So we do see an increase, and we see Costco, general trend upward, same thing with Dollar General. The reason I didn't like Dollar Tree here, we started off really, really strong, 2014, 2015. Then we had a huge dip here. They did bounce back a little bit, but I didn't put them on my favorites. PE ratio, with this industry, they all kind of ran around the same numbers. They're very, very similar. So I didn't pick anybody out of price earnings ratio just because they were all relatively close. Price to book, somebody stuck out to me as Costco. So once again, I like that general upward trend, and we see that here with Costco. PEG ratio, I like Dollar General, I like Dollar Tree here. Lower the better. So this to me basically means we can kind of trust our growth rates. What the market's telling us, what we're computing are the closer to 1, the closer those numbers are. So Dollar General and Dollar Tree, I do like right here. Enterprise value, theoretical takeover price of the firm. No surprise here, Walmart is more than three times bigger than any other firm here. So Walmart here is worth a ton. Nobody really even comes close. EVA spread, by what margin did we exceed shareholder expectation? So I like Costco and I like Dollar General here. We see consistency and we see increases over the years. And then at the bottom is just the enterprise value multiple, and I chose Target for that one. So current stock price and projections. This is our current stock price as of July 18th at 4 p.m. At the close. So those current stock prices, these projections, not perfect for sure. What I did was I looked at PE ratios, I looked at their projected earnings per shares over the next 2 years. I took their most recent PE ratio, and that's how I came up with year 1 projection, year 2 projection. And then this is just a percentage change from the current price to the year 2 projection. So I like Walmart here. We see a 36.66% change from the current price at 88 to 120.36 in 2 years. Same thing, Dollar General, we see a 46% change, and Dollar Tree, we saw a 63% change. Now, obviously, this may not work out like this. It's very hard to predict what the market's going to do. This could be totally wrong. But we needed something to go off of, and I wanted to kind of stay consistent with this. So this is just looking at supply chain, the number of suppliers. I expected Target, Walmart, Costco to be bigger because those stores are bigger, just bigger firms than Dollar General and Dollar Tree. But nobody here had a number that was low enough for me to really be worried. So this didn't really, sway me one way or the other. This was per Yahoo Finance. This is kind of the little grid up here that they use to rate stocks. And these were just the ratings of what they recommend: strong buy, hold, underperform, or sell. The lower the better. And so these are all pretty close together. Once again, not really going to sway me one way or the other. So, who's the best out of this firm? I wanted to pick Dollar General because they kind of outperform Walmart in most aspects. They had higher operating profit margins and a higher ROE. It also had an impressive EVA spread. There's one reason I did not pick Dollar General, and that is the future. So I'm looking towards the future. I see what Walmart's doing. Just released in Yahoo Finance, Walmart's actually trying to pair with Microsoft, kind of team up and give Netflix a run for their money. I think they want to come out with a streaming service. They're also working on some cloud stuff as well, give Amazon a run for their money. I use Walmart Pickup. That's been huge. So I expect Walmart to grow because they are huge. They're becoming an e-commerce giant. Walmart.com, Walmart Pickup. The problem is Dollar General, they look great right now. The numbers are great. But looking towards the future, I didn't even know Dollar General had a website that you could order stuff off of before this. I don't see them having a huge presence with e-commerce. And I think we're moving towards online shopping. We're moving towards getting out of the store, getting online, quicker, comparing prices, and I don't see Dollar General being there with somebody like Walmart. So for that reason, I choose Walmart. All right, my next industry, e-commerce, discretionary. So we got Wayfair, retails household goods, bedroom, living room, kitchen and dining, etc. Netflix, internet subscription service for watching television shows and movies. Amazon, an online retailer, a giant that offers a wide range of products. Just had Prime Day. Apple, I know you know what Apple is. Design, manufacture, market personal computers, mobile communication devices, etc. eBay is a global commerce company. Enables sellers worldwide to organize and offer their inventory for sale and buyers to find and buy it. 5 popular companies. So let's look at short-term solvency again. Once again, current ratio. Nobody here really stuck out to me, worried me. Quick ratio, I didn't really like. Netflix was a little bit lower than the other ones when you take out inventory. Cash ratio. eBay was really, they held on to a lot more cash than the other 4 firms, but this doesn't really trouble me, or nobody really sticks out in terms of short-term solvency. All right, borrowing, equity multiplier. So I like Apple, I like eBay here. Lower the number, the better. So we don't see any crazy numbers. We see a trend, and we see lower numbers than the other 3 firms. And they can all afford their interest. So Apple and eBay in terms of long-term solvency. Profitability. So tax burden, like I said before, tax burden, interest burden, I don't want that driving return on equity. I didn't like eBay here. It looks like they got some kind of tax credit, and we just had some funky numbers here. Ended up with a negative. This is all pulled by Bloomberg, so I didn't like that. And then had trouble pulling interest from Wayfair. Looking at EBIT margin, operating margin, very important. Apple and eBay. They are way above the other 3 firms. We actually see all negative numbers with Wayfair, but we see low numbers. Netflix, Amazon, Apple, and eBay, very efficient, great operating margin. Profit margin. So you'll kind of see a trend, Apple, Apple, Apple. Profit margin, not even in the same ballpark as the rest of the 4 firms. Very consistent and way, way above the other 4. Total asset turnover, one thing that Apple did not have. So Wayfair, very efficient with total asset turnover, and Amazon was more efficient. And we already looked at equity multiplier. Profitability. So return on assets, return on equity. Once again, Apple just about doubles everybody else. So Apple return on assets, we see we do see a decrease here, but these numbers are so much higher than the rest of the four that I'd be crazy not to pick anything but Apple. Same thing with return on equity. We actually see increases here, and they are more than double the rest of the companies. PE ratio, I kind of almost want to throw this out just because these numbers are all over the place. There's a lot of volatility. We see some crazy numbers that have some missing data that Bloomberg could not pull, so I won't say a whole lot about that. Price to book, I like Netflix, I like Amazon, and the PEG ratio, looking at the growth rates, we see some low numbers here. I like Apple. Enterprise value. So right here, our two giants are Amazon and Apple. No surprise. Actually found on Yahoo Finance, there's currently a race between Amazon and Apple to see who can become the first company with a valuation of $1 trillion. There's two different stock prices that they have to hit in order to get that valuation of $1 trillion. They're both relatively close. It seems like it's kind of neck and neck, but analysts are saying that they do anticipate Apple to be the first company to hit $1 trillion valuation. EVA spread, by what margin are we exceeding shareholder expectations? Apple all the way. They, every single year out of these 5 that I took, exceeded, by a great deal, exceeded shareholder expectation. And then enterprise value multiple, I like Apple and eBay here. So current stock prices, I already explained how I came up with this. Some of these numbers are really high. So Wayfair didn't have PE ratios, couldn't even come up with theirs. Netflix, right now, at the close, 4 p.m. on 7/18, it closed at 375.13. Year one projection I got was 389 and 625, so we see a pretty significant, change here, percentage change. Amazon, these numbers are crazy. Of course, I'm sure, looking back now, people thought that this number's crazy and this is what it's currently trading at. But I got some huge numbers by looking at their PE ratio and expected earnings per share, a 181% change. So, I don't know if that's going to happen, but like I said, I want to stay consistent and give us a way to kind of measure these. Apple, 17% change here, currently trading at 190, and then eBay also a significant percentage change of 108.14. So supply chain, my Amazon and Apple, great deal of suppliers, great deal of customers. I had trouble pulling data on the other ones. They're much smaller, obviously, than Amazon and Apple anyway. And then same thing, this recommendation rating per Yahoo Finance. They're all pretty neck and neck. Amazon was the strongest, considered between a strong buy and a buy right now by analysts. So who's my favorite here? Apple by far. Apple dominated the other 4 companies in almost every single category I analyzed. Already talked about the race to 1 trillion. They're a strong company. They're stronger in just about every way imaginable. I don't see that changing anytime soon. They're growing and growing and growing. So out of the companies, Apple is my favorite by far. Put it up against Dollar General, put it up against Walmart. I'll show you that in a second. Apple wins. All right, so there's a lot going on here, but basically I took Apple and I'm comparing it with the other industry, and I just picked whoever looked the best in these certain categories at that other industry. And as you can see, they dominate. I mean, equity multiplier, we did see that Dollar General had slightly lower borrowing. Profit margin though, Apple, whole another just different world than Dollar Tree. Way, way higher, comparing this 21.09 to 7.71. Their operating margin, significantly higher than Dollar General and Dollar Tree. Their return on assets, ROA, once again, higher than Dollar General. And like I said, these other companies in the other industry they had the highest numbers. So I'm just showing you that Apple beat the best company in the other industry in just about everything. ROE, same thing. Apple 36.87 compared to Dollar General's 26.69. And then EVA spread, they exceeded shareholder expectation by a much greater amount than Dollar General did. All right, so thank you for watching. I appreciate it.